Hello and welcome to KYC, that is Know Your Company on NDTV Profit. My name is Hiral Datia and with me is Puneet Javeri. Today on KYC, we are going to actually dissect a Quess Corp in trade. It's going to be an interesting company to talk about, and the scenario is absolutely interesting as well. The reason being is what's happening with hirings right now, because all of us have been talking about the negative impact in terms of where IT as a sector goes, because that's where majority of the downtake that has happened so far. But let's quickly run you through as to why a Quess Corp. Firstly, we want to understand the business outlook for FY26, and the reason why this is important is after the three-way demerger that has happened, how is business actually shaping up? Moving on, if you talk about the other aspects, which segments will lead the hiring in the second and the third quarter, which usually is an absolutely strong quarter? That's the second question that we ask. On number 3, what's the outlook looking like for GCC hiring, as IT as a sector has been slowing down as well? And moving on, can the professional staffing sustain the double-digit margins that we've seen so far? So these are a few of the questions that are on my list. Puneet, what are you going to look at as well?
I think one of the key aspects is, of course, of the company is largely into hiring for both banking as well as for technology, and that space has been largely impacted from the tech space. So I think that will be one. Monsoons, amongst other reasons, has been one of the key aspects which is impacting a lot of companies, but those are some of the key aspects to look at.
Right. In fact, will Middle East and Singapore growth also continue from here on is what we need to watch. What's the plan for on-site as well as GCC business transfer is what we should be looking at. And very lastly, how is the Hamara Jobs-ONDC integration progressing for the company? So we usually look at 5 questions. These are 8 questions that we will try looking at with the management from here on. But moving on, let me quickly take you through, about Quess Corp. Firstly, as we know, the company is in the business of overall staffing is what we know. Apart from that, if you look at the presence, 9 countries is what they're present in, and they have a workforce of little over 550,000 associates, serving over 3,000 clients across diverse sectors. Talking about the demerger as well, they have done a 3-way demerger. All the 3 companies have been separately listed now. The main business, which is Quess Corp, is into workforce management. And the first new company is Digitide, which is into BPM solutions, InsurTech, as well as the HRO business. If you talk about the second one, which is Bluespring, that company is into facility management, industrial services, as well as investments. Overall, if you talk about the market split as well, Quess Corp, it actually had a market cap of around 3,900 odd crores, Digitide around 2,900 odd crores, and Bluespring around 1,200 odd crores. And this is basis the split that had happened then. So let's just be very mindful of that aspect. If you talk about the first quarter as well, in terms of the matrix, Quess Corp around revenue of around 3,650 odd crores on a PAT of 50 crores. Bluespring reported a loss and a revenue of around 800 odd crores, and Digitide a profit of around 10 odd crores on a revenue of around 740 odd crores. General staffing, professional staffing, overseas business, and digital platforms, these are the segmentals that you're looking at, where general and professional has seen an uptick, whereas overseas business and the digital platform has seen a degrowth from 5 to 18%. So that's with regards to everything that you need to know about the company. But let's quickly take you through the rating parameters from here on. On the first one, we have the income statement that we are talking about as well. We'll talk about the balance sheet, cash flow, return ratios. Moving on, if you have to look at the other 4 parameters, the shareholding, street credentials, street coverage, and valuations. This is what we will discuss from here on. Puneet, let's start with the income statement.
Well, definitely, it is one of the key aspects, because we've seen the demerger happening now of this particular entity. So you are seeing some kind of revenue correction that we've seen. Now, for FY25, and we've only taken the last 2 years because these are comparable post the demerger. If you see from the FY23 level, compare the FY25 revenue, you will see a dip, and that's largely because the two demergers of the two new companies that Hero just spoke about. So in that aspects, 14,990 crores is what they did in FY25. It is a growth, but you'll see that there's an impact on the net profit substantially. It's down almost 6 times from the FY24 level. This was largely because of a demerger expense of about 30 to 40 odd crores that they did, as well as a write-off of about 118 odd crores, which impacted the profitability in FY25. So that has dragged down essentially the ratio in this particular aspect, and for that reason, we've given this a thumbs down. And in FY26, they are expecting some of these expenses won't be a part, especially the demerger expenses. The receivable aspect will be something that we'll quiz the management on, but on this aspect, we've given this a thumbs down.
Right, so that's with the income statement. Let's quickly look at the second parameter, which is the balance sheet of the company. Now, what's interesting in terms of the balance sheet is their net worth to an extent has come down significantly from a 2,800 crores that we saw in FY24. It's actually come down to little over 1,000 odd crores. And in terms of the cash and bank as well, that is nearly halved for the company. So these are two aspects that we are looking at, because of which we are giving it an absolute neutral rating so far.
Specifically, this has also seen that kind of demerger impact, which we've seen move
There
into
will be some movement that will
Bluespring.
happen, correct, to the other companies, which is Bluespring and Digitide.
Yeah. And in terms of cash flow, let's move on to the third metric now, and that largely seems to be stable-ish to say the least, because we've seen that kind of degrowth in terms of hiring trends. You're seeing that impact in FY25 as well. Company is guiding for a better performance in FY26 that will be led by professional staffing as well as the hiring in GCC trends. So we've given this a neutral, not given this an absolute thumbs down, largely basis of this aspect of a better outlook. But for FY25, it was still a better performance compared to FY23, but a neutral rating, giving the uncertainty in hiring for the tech as well as among the other sectors that it caters to.
Okay, so that's with regards to where cash flows go, but let's look at the return ratios. Now, what's interesting with the return ratios is if you have to look at 23, 24 and 25, it's the lowest. So clearly, the return ratios are well below your historic highs that you've seen as well. In fact, 10.36 is where the return on capital employed was in 2024, 23, 8.45, and right now 2.92 is really low. Simultaneously, if you talk about the return on equity as well, there again that number is in single digits, 2.36 lower level, versus a 10.35 and a 8.97 that we've seen in the previous years. So clearly there is improvement that is needed on the return ratios, and that's the reason why we give it a thumbs down so far.
And essentially, the return ratios are expected to go and do better going forward, largely led by, what is happening in GCC trends amongst others, because that is a very, very high margin business for the company. But clearly the trends, seeing that impact of the high margin businesses moving to the other key verticals, and hence thumbs down. The next one is shareholding, and this largely, we've given this, in terms of shareholding, largely, in this particular aspect, a thumbs up, and that's because of maintenance of that kind of shareholding that this one has kept. So from 56%, it's largely been there. We've seen some increase from March of 2024 in terms of the level for public shareholders, and hence, we've seen in terms of the stock largely underperforming, the retail investors coming in anticipation of a better growth area. But we've given this a thumbs up based on the confidence that the promoter has kept in the business.
Okay, so that's with regards to where the overall return ratio shareholding goes. Street credentials is that we've already spoken about as well. Valuations, let's quickly look at that aspect from here on. If we can just get the overall street creds on the screen. In the last 6 months, we've seen a downtick of around 55 to 56% in terms of where the stock price goes. That the counter has actually underperformed in all parameters. If you have to look at the last 5 years as well, it's a downtick of around 31, 32%. So not really rewarded the shareholders to that extent. So that is what we need to look at from here on. But, as Puneet was mentioning, the GCC hiring, which is a high margin business from here on, if that is able to improve the business, in turn, improve the return ratios as well, potential for things to come up and reverse? And that's a question that we will check with the management. But overall, a thumbs down in terms of the street credentials, Puneet.
Well, and that's largely also seeing that kind of merger impact, which we saw in April. About pre-merger, the price was 604. Post-merger, we saw that dip to 400. But since then as well, we've seen some form of impact on Quess Corp, largely basis on the operating performance as well. In terms of valuations, the nearest competitor is TeamLease, and we've always seen that kind of valuation differential between both these firms. Currently, valuation for both seems to be, on the lower side for FY27 specifically, baking in the negatives for this year. The outlook, of course, will be something to watch out for as we go into Q2 and Q3. Q2 and Q3 are, big seasons for hiring, and that does benefit companies like Quess Corp as well as TeamLease. But at least for on both the next couple of years, we've seen valuations largely been positive compared to TeamLease. But in terms of growth, that largely has been absent, and hence we're giving this a neutral for now. But in terms of commentary, that depends on what happens in Q2 and Q3, has some upside risk to say the least, and that's reflected essentially in the analyst ratings as well.
Valuations absolutely reflective in analyst ratings, but let's quickly just go through everything in terms of the street credentials that we're looking at in terms of coverage. 8 buy calls, 1 hold, but with that as well, you have a 42% upside, right? So from what Puneet is mentioning about from a valuation perspective, the business perspective, the GCC that could start contributing, probably that is what is being indicated in the upside that, the analysts are giving right now. And 8 is not a bad number, and hence a thumbs up in terms of where the street credentials go, the coverage goes. Let's quickly look at the final performance now. So the income statement is a thumbs down, and your return ratios are a thumbs down. If improvement comes in, probably that could change in the future. Balance sheet cash flow, absolutely neutral because of the impact of the demerger that we've seen. Your shareholding, street coverage, both are a thumbs up. Valuation right now is sideways, but your credentials, because of the returns that it has given to investors, is a thumbs down right now. So from 8, the overall rating is a 3.5 in terms of where Quess Corp goes right now. The conversation that we will have with the management is actually going to tell us how this 3.5 probably will improve from here on or not. Let me welcome in Guruprasad Srinivasan, Executive Director and CEO at Quess Corp. Srinivasan, welcome to the show, and a pleasure to speak to you at NDTV Profit as always. My first question coming to you is, overall, with the demerger that has been done, now the business that Quess Corp will actually focus on, what's the outlook looking for FY26? Because usually Q2, Q3 is a strong quarter for the company. So taking aspects into consideration with what's happening around IT, the GCC business that you're looking at as well, which is a high margin business, how is Quess Corp actually stacking up?
Sure. Thank you so much, and happy to join you all on this call. So first and foremost, let me start from the demerger structure in itself. So we had a very successful demerger, which officially we announced, and 2 other companies that got listed in the month of June. So Q4 results itself, if you look at, we started, announcing the result independently by each of these entities. So Q1 is the first, standalone result that we announced of independent entity Quess Corp. A couple of specific callouts. First and foremost, we had a double-digit EBITDA growth year on year, and our debt levels have become, for Quess Corp, debt level is, we are a debt-free company now. And the other parameters are like post-demerger, the business structure in itself has become far simpler. So we have 4 line of businesses. The first one is general staffing, which contributes about 53% of our EBITDA comes from general staffing business. The second set of business is India professional staffing, where 29% of our EBITDA comes from India professional staffing business. The third quadrant is our international business. About 18% comes from our international, 18% EBITDA comes from our international business. And the last one is a digital platform which we have incubated for future in terms of building our digital strategies around. So 4 line of businesses: simplification of corporate structure and debt free and much leaner balance sheet is what we were able to achieve by Q1, and we've just announced that as a result.
Mr. Srinivasan, good morning, sir, and thanks so much for joining in. It's Puneet this side. You mentioned that debt has now, wiped off from the balance sheet. Essentially, that will help the return ratios for you going forward. In terms of, hiring trends, if you can give us some perspective. Q2, Q3 generally is very strong for you. We're almost, halfway through Q2, and while you can't talk about numbers, have you seen any kind of hiring revival essentially in sectors like technology amongst others? If you can give us some perspective.
So let me go by platform and business. So Q2 has been definitely, we see a lot of green shots coming across Q2. If I were to start specifically from a segment, if you look at, I think, general staffing, we have an open mandate of almost about 40,000 plus. To be precise, about 42,000 open mandate that we are on. It's a good way to start Q2. And between July and August, we have done substantial hiring, specifically in manufacturing, consumer retail, and telecom. As you rightly said, India being the season between July to up until Diwali till October, we are seeing mandates, open mandates being fulfilled, and the other sector is supply chain logistics. Specifically, I think one or two sectors which are a little slow than anticipated is BFSI is slightly slow, but otherwise manufacturing, consumer retail, telecom, and supply chain logistics is doing well. Coming to professional staffing, GCC has been the most spoken about, and we are definitely, while the mandate quantum may not be high, our fulfillment ratios are far better, and we have been able to do good. Almost 70% of our fulfillment comes from specifically from GCC as a segment. So a couple of indicators probably that viewers would be interested. The rural consumption is far higher than urban consumption. 75% rural consumption is coming up from, and that leads to a lot of expense and the investments that can go into the segment, which is helping us to probably do our more open mandates are coming in from tier 2 and tier 3 segments, which is good to see than the key markets and urban markets. So almost 37% of our hiring we have done in tier 2 and tier 3 cities as we speak, and most of the manufacturing units are also being set up in tier 2 and tier 3 locations. So that's where we are now seeing a lot of demand coming in, which is in a way good for country like us. There will be more spending pattern in rural markets. So that is going to give rise to more jobs as we move forward.
Okay. So when you talk about, an uptick that's coming in from tier 2 and tier 3 as well, which segments are you looking at in terms of hiring? What percentage of your revenues will come in from there? And in turn, the margin impact that you see, is it a low margin game or is it a high margin game?
See, staffing would always would be in a range between 1.4 to 1.5% in terms of EBITDA, because it's a volume game. And the way we reorient ourselves is we definitely headcount is important for us, but profitability is much more important than our revenue. So we focus on our profitability for this business, specifically for general staffing, and of course, professional staffing has always been on EBITDA measurement. So coming back to your question, one third, almost, I said 37% of our hiring is coming in from tier 2, tier 3 segments. Again, the segments which are driving this are manufacturing, consumer retail and telecom, and logistic and supply chain. More e-commerce going closer to the customer in tier 2, tier 3 location, and you need entire delivery and solutioning around it to cater to their customer needs. So plus the retail being the season, and more retail going closer in tier 2, tier 3 location rollout. That is what, these are three segments which are driving, and it also reflects in a similar ratio in our revenue as well as we move forward.
Mr. Srinivasan, my question then is, you're talking about that margin range of 1.3 to 1.5% when it comes to staffing. But now that you're focusing on GCC, you're expanding into, global technology services, which is a high margin business. Do you see that further upside that could come in? And if yes, what should that range look like then?
Good question. So if you look at our results between Q4 and Q1, our contribution from general staffing in Q4 was about 59%. The EBITDA contribution, what I mean, and in Q1, that 59% has come down to about 53%. So while headcount grew and we had net additions, our contribution to overall EBITDA as a work as across Quess for general staffing came down from 59 to 53. So on the same way, if you take the second quadrant, which is our professional staffing, from 21% we moved to 29%, which means our high margin businesses are contributing well back, which is helping us to, our overall blended margin across group, we moved from 1.8 to about 1.9. And by end of this year, we've been guiding and we are modeling accordingly to be around 2%, and we are on course to that.
Mr. Srinivasan, sir, a couple of questions. Now, on professional services, you mentioned professional staffing, you mentioned that, the contribution of EBITDA has gone down to 53%, but that continues to be, where the growth essentially seems to be visible. Could you talk to us about what is your strategy for increasing your GCC contribution? Because I think you mentioned that you're roughly around target. You already have 157 GCC companies that you work with, but the scope in India with the increasing focus seems to be much higher. So could you just talk to us about the opportunity, and if you can give us some kind of quantification that we could see in the next year or next couple of years for you specifically from within the segment?
I think just one correction. You said 53%. What I referred to was general staffing contribution coming down from 59 to 50. So that is what I mentioned. And our high margin businesses going up from 21 to 29%. So that's what I was trying to clarify. And coming back to GCCs continues to be, we have, there are about, if you look at, there are about 1,600 GCCs expected to grow at 13% year on year. By 2030, it is expected to be about 2,500 GCCs who are going to set up their captives back in the country, of which currently from 1,600 we cater to about 10% of GCCs in terms of hiring. Almost about 3,000 plus around 3,300 headcount of ours are currently present in GCC. So with this, we continue to grow. Probably, I think over 20%. I wouldn't hesitate to say that the kind of demand that is coming in and the fulfillment which is coming in. And as a company, we also pivoted to cater to, in terms of building better recruiter capability, bringing in more AI and digital as part of our mix to ensure that fulfillment and delivery happens much quicker and faster. So definitely this particular segment, which is high margin, would continue to grow about 20% year on year for us, and we are slated towards that.
Okay. And when you talk about IT as a segment as well, that's seeing some bit of softness right now. And plus you've seen a decline in terms of the open job mandates as well, right? So how are you actually strategizing to navigate this aspect? Because that is something which has been reflected in the fourth quarter numbers as well.
So this is specific, has been the trend for IT services companies. For all IT services companies, absolutely, I would we are not seeing any major demand coming in for, Q3 as well this year, as we're already close to Q3. This has been the phenomenon for almost last 6 to 8 quarters, and we've only seen headcount coming down there. However, our exposure to IT services is about 15 to 16%. We do hire in a very small format even now, but the exposure or the kind of the percentage what we cater to is about 15 to 16% currently. But otherwise, majority of our demand still comes from out of IT services. See, the other two quadrants beyond IT services are GCC, and another segment within this is all the non-tech companies hiring tech talent for domestic consumption. So there we are seeing a lot of traction. Like, companies are into their own automation journey, and there we are seeing demand coming in for non-tech companies hiring a lot of tech talent. Like, I mean, look at Quess itself. We'll have about 200 tech talent for our own technology and strategy. People are working for us, which probably 3 years ago wouldn't have been the kind of people. I mean, the kind of population that we will have only for technology. So the local adoption is also going up. So from that standpoint, the demand we still continue, or we will continue to see. I mean, coming in from specifically from non-tech companies hiring tech talent, and GCCs will continue to contribute more this year.
Right. So, Mr. Srinivasan, everything said and done, understanding what the business is doing, where it is going, what the investors now want to know is when do they start seeing good returns, right? I'm sure you cannot really respond in terms of the way stock is moving, but let's understand from a return ratio perspective as well. We've seen levels of 10.3, 10.4 on both ROE and ROCE. How long will it take you to get there, number one? And two, what's the immediate target that the company has in terms of improvement from levels of 2.9 right now?
So when would the indicators look better? Definitely this year itself. I wouldn't hesitate to say that for multiple reasons. One is we are a debt-free company, and in terms of our equity level post demerger is almost about. I mean, if I look at the kind of trajectory that we are in, between 4 quarter, we would roughly. We'll roughly deliver about 350 crores of EBITDA, and our conversion from EBITDA to PAT is higher because there is no much of depreciation line item. So from that standpoint, we are very well slated to be close to a 20% ROE company, which we have been aspirational for some time. But this year, I definitely foresee that indicator is going to be definitely ticked as a group for us. And of course, the market.
Higher single digits?
Oh, yeah, absolutely. We'll be close to higher teens.
Okay. You're saying in the ROE, ROCE, you'll be in higher teens?
Absolutely.
All right. This is something which I think the street was watching out for. But thank you. Completely running out of time, Mr. Srinivasan, for joining us on the show. So that was the management of Quess Corp talking to us in terms of what's expected. And I think, Puneet, the last answer is something which actually would make the investors' day. From a 2.9 to a higher teens number is really strong.
Well, definitely. And I think those key aspects which we gave a thumbs down on, those did get addressed in this conversation.
So I think that's something we should be revisiting soon, but completely out of time. With that, it's a wrap on this edition of Know Your Company. Lots more lined up on the other side. Please stay tuned to NDTV Profit.